Welcome to your next podcast episode of Beyond the Focus, where smart tax moves are going to help to make a move early in the year. So don't miss your chances. Today, joining me is Nolan, and instead of us talking about this near the end of the year, we hear a lot of questions around the beginning of the year and planning. So Beyond the Focus is really going to help with these smart moves now. Have your pen and paper ready, take some notes, and beyond all, I want to welcome people to our Beyond the Focus. This really is where clarity meets confidence. And at McIntosh and Associates, we believe that retirement is about more than numbers. It's about living your life you've worked so hard for. Today, we're not talking to just anyone, but we're talking about all of your favorite topics. So month over month, we're going to kind of bring in and try some new exciting ways to deliver what's truly important to you. And sometimes the smartest tax decisions, they really don't happen in December. They happen right now. Wouldn't you agree, Nolan?
They can. They certainly can. Yes. It's one of those things that you can possibly save money and look at some things in the beginning. So let's jump in and talk a little bit about 401k updates. A lot of things happening in the 401k space.
All right. So we've had quite a few calls really about 401ks, contributions, the changes, even tax forms. And usually the tone of those calls is something like, well, what's changed now? So what can you share with us about that?
Yeah, for 2026, a lot of different things have happened in the 401k space. And so some of the few updates here, the standard 401k contribution limit is now $24,500. But if you're 50 years or older, you can actually do a catch-up of $8,000 there. So a lot more wiggle room now than there was in the past. But if you earned more than 100, this is the new rule. But if you're a high income earner, this is what they consider a high income earner. If you're over $150,000 in wages, then your catch-up contribution actually has to go into the Roth account, which is interesting because some employers may or may not have a Roth out there. If they don't, then they can't allow for your high income earners to be able to put into the catch-up because there's no Roth availability.
So a big thing is Roth 401k, I think, is a resounding yes here, even at our firm. And that's where people really can kind of pause because they hear Roth and sometimes they think, well, gosh, do I have to pay taxes on this now, right? And am I already above the phase out contribution limits of what the Roth is? But we really need to take a look at taxes overall and what that means as far as taxable brackets. Even in my book, Cultivate Wealth, we have a lot of great information about paying tax on the seed, which yes is today, so that you don't pay on this ballooned harvest later in the future. So we have clients call and say, well, it really feels like, couldn't this be less of a benefit if we're putting into the Roth portion now? And once we walk through it, people really can realize in their own, what we call retirement tax bill, will provide you a deliverable that can actually talk about what does the time value of money look like of paying taxes today versus deferring it to pay later on, and what the income even is going to look like either way. So biggest difference is how the growth is taxed. And then when we do withdraw later in life for income, for fun, for updates, this is really where you're going to realize that tax-free growth later can be an amazing way to be able to help with the status of that moving later into a preferred tax strategy.
Yeah, absolutely. We'll take that, right?
So here's where we take a look at a specific opportunity for people that are age 60 to 63. And Nolan and I really talk about this. It feels like all day, every day that the folks that we're working with, taxes is almost more important now than growth in the investment accounts themselves.
Yeah. Whoever thought that getting a little bit older actually can make some special things happen, right? So that group from 60 to 63 that Mindy had just talked about, we had talked about the 50 and older age group, right? They get an extra $8,000 in their 401k as a catch-up. And then again, reiterating that our higher income earners, they only have specific ways they can actually do catch-up allowances. But if you're in the special age group of 60 to 63, your catch-up is actually $11,250. So that's an actual possible contribution of up to $35,750 per year that you can actually put into those. So as we know, some of our people out there that are listening, they may or may not have thought that they're behind the 8 ball, they're behind on their contributions. This is a good way to maybe catch up and maybe make up for some of the years that they didn't contribute to the 401k like they would have in the past.
Yeah, and planning and just having a plan, conversations, things on paper. What can we do now instead of always looking at hindsight? We're looking at what was the year of 2025 for you? How do we actually plan now for taxes as we're getting ready to prepare taxes, looking in early at what do we round out with for 2025? And then how are we approaching early on in the year, all of 2026? So when we see these rare moments of people turning 60, we're not there yet, but before you know it.
We will.
I call that 60 years young for those of you that are 60. But you don't get many of those chances. So we really take a look at from 401ks and then also with the IRAs. So contributions that people are making to their IRAs. We'd like to talk about something that people forget about a lot of times, really every single year. So we see clients and neighbors of ours that really take a look at their IRA contributions can happen after December 31st. So Nolan, what might that look like for folks?
So we talked about early in the year, if we forgot, right, because life gets in the way, holiday season, things of that nature, we actually have time to make it up. And so what's really important here is that if we are going to make a contribution for your 2025 season, you actually can have all the way till April 15th to do that. What we would have to really make sure we're careful of is making sure that when we put that contribution in, that whoever your custodian is, that they know that that is for 2025 and not for 2026. So just make sure that if you are going to do that catch-up contribution for the 2025 season, because you missed it, you do have till April 15th, just make sure that the custodian knows about it.
Well, we just had a couple come in and they just felt really defeated. Here it was February and they thought, oh no, well, we missed it, they said. And realistically, no, you're still a little bit early. So you have time. You're still ahead of the game, I call that. And they were so thrilled and excited. And the nice thing is, what's really funny is no one usually leaves a financial visit, right? Or a focus visit here saying, well, that was exciting, but this was the day we created excitement for when people were actually able to leave. So I think that that's important. Another really talkative segment that we've been talking about a lot, Nolan and I have really been talking about charitable contributions, charitable donations, and we really want to talk about giving because it really matters. So if we're utilizing the term QCDs here, Nolan, what might that mean for our listeners and the families we're helping?
Yeah, I think it's one of those things that everybody hears QCD and they don't really understand what that means, but what it stands for is Qualified Charitable Donation. This is really important for somebody that's a little bit older, maybe 70 and a half or older. What the government allows us to do is they allow us to use some of our tax deferred accounts out there, whether it be 401ks, IRAs, 403bs, 457s. Now, granted, most of the 401k, 457 world doesn't allow you to do this. That's why you have to move it to an IRA in order to be in this tax advantage type of situation. But after your 70 and a half birthday, you can actually start using your IRAs for qualified charitable donations, meaning charity. So therefore, if you would normally give to your church or a charity of your choice year after year, we would want you to do that through your IRA instead of from your bank account, because then you can actually write that off on your taxes to be able to say we didn't have this as income, and the charity themselves also doesn't pay tax on that. So it's a great way to give the same way in a different manner that makes it more tax favorable. So it's not like we're going to do something different as far as our giving amount. We're just doing it in a different way to make it more tax efficient.
Sure. And we can have you have this being pulled, let's say, from even an investment account, and it can monthly go in. Numerous of our clients do this. It can go monthly actually right into a checking account. And then you can write the checks out of there to your church, to your charity. Nolan's pretty big on folds of honor, and there's some different things that we do with American Cancer Society and such here. But outside of just what you're giving at church, it does allow more to go through there as well. So you can switch it to a QCD. Some, generally speaking, you'll pay less taxes, Nolan said, and it's just more of a preferable route for it to go. And you still feel, we do have some clients like to come in with their check register and mark it all off and still keep it on paper and pen. You can do that and find clarity there as well. So if you're under, 70 and a half and you're donating even, let's say, appreciated stock, this can be very powerful. We have clients that have had stock they owned more than 15 plus years. And if they sold it, capital gains tax would have showed up like uninvited guest knocking on your door. And instead, they donated the shares, and there wasn't capital gains then. They could receive the full value to the charity, and everyone wins. It's a positive side to each side.
Yeah, absolutely. And there's another way you can even look at capital gains too, is that if we do have highly appreciated stock in these kind of accounts, there are some interesting things called donor advised funds that we can use. And then instead of doing it in that year, giving it all to charity, you could actually piece it out over your lifetime on how we want to give those to your charities of choice. So there are some interesting ways we can even work around capital gains, not just QCDs, right? Qualified charitable donations, but even through capital gains, we can do some interesting things there.
Which is nice. And then we talk a lot here. Probably one of the top 3 things you hear a lot is income planning. Where's our income going to come from? Do I have enough? Are things going to be okay? And when we talk about income planning, even when we're talking around taxes, we really are talking about Roth conversions, right? So how do we do Roth conversions now? Create and generate some tax-free income later. And then how do people really find intentionality to create a withdrawal strategy for how they're going to draw funds later and without having any problems kind of arise from that nature?
Yeah, and so, a lot of times we'll do, from a tax strategy standpoint, if we know we have expenses and things of that nature we're going to need for our income, then, maybe we wait to do some of those tax planning like Roth conversions or that matter later in the year, so that way we don't have any income surprises. Because the challenge we have is that nobody knows what the year brings. And so let's say we're going to give to the kids, things of that nature, and we just didn't expect the kids to need that much. It might be one of those things that instead of doing a Roth conversion earlier, we might want to wait a little bit later. So that way that becomes less of a taxable hit. But yet you still get to give to the kids and things of that nature that you want to do.
So for most of you, you know how to accumulate wealth, right? You go to work, you know how to earn a paycheck and then decide what you're spending there. But now when we have someone coming in and they're retired and they're saying, look, we're buying a different vehicle. We're going to have an SUV. We're going to receive a travel trailer. We're going to travel across the country and visit grandkids. And they wonder, well, don't I just pull from my IRA? Or which assets am I pulling from and why? This is why Nolan says we don't always just do all the conversions early in the year. Sometimes instead of converting it, this is money you're actually going to use for the new purchase. Like anything, we want to enter with clarity and walk through what it's going to be right for you, what consequences it can have from there, even other things that can even affect like what they're going to pay in IRMA or taxes to Medicare. And so we want to make sure that this is all clear and accurate as we walk down the next steps. IRA withdrawal strategies too, we really take a look for the space, as Nolan said, year by year. Even though we're talking about it early in the year, it also might give you some more wiggle room to say, we're going to take that next vacation with the grandkids. We are looking at expanding to have a second home or a cabin. These small decisions then make that nice ripple effect as we can look year over year of what's going to be the best for you. We're taking a look at estimated taxes, overall wealth, and income to you as well.
Mm-hmm. So talk a little bit about those estimated tax payments. Not glamorous, but important, right? The projections are always one of those things, especially if we're under 65 in health insurance. Those are the things that we look at. So let's talk a little bit about some of those income possible surprises that we may have in estimated taxes.
Yeah. And what are some of those income sources, Nolan, that people should be thinking about?
Well, some of the things that we don't do is if we don't know where our taxes should be, sometimes we don't withhold enough from our sources of income that we are pulling from. And so that's the challenge, is that if we're pulling too much, we may have to make quarterly payments. And we don't want the IRS to get more of our money than we already have. And if we don't do it correctly, then we can get some penalties. But typically, what we look at for those quarterlies would be obviously at the end of the months, right? So you're going to have your September payments and your January payments and your June payments and things of that nature. So that's one of those things that we can look at and say, does it make sense if we're in a higher income earning status that we should be paying those quarterly rates?
And I think it's a great way to look too, because some folks just don't realize that, gosh, I really should have been set up on quarterly payments. I just thought I'd receive a tax bill at the end of the year, or I get a notice. Well, your notice is really us just reviewing together and taking a look, because technically, yes, you could get a tax bill, but we don't want to then hear after the fact and have penalties. We want to make sure that we're preferring it up front, and even talking to your tax accountant, your CPA, because we don't want any surprises from the IRS. We want birthday surprises, fun, Christmas, not the IRS.
No, IRS is not fun to deal with.
What, you didn't like the Christmas gift for Naomi and the fun little leopard gecko? If anybody hasn't seen, you do need to look at our personal Facebook, though, for listeners on if you want to hear about surprises. Christmas morning in our house this past year, was really pretty great. Our 11-year-old received a crested gecko, and she had the shock of the century. So those are good surprises that we definitely do want to see. So let's plan ahead so we can focus on the things that are more important, that being family.
There you go. So if you have a tax surprise, go get a gecko is what we're trying to tell you.
So let's actually talk a little bit more too, even about standardized deductions, right? So we're talking about fun things, good surprises, things that we don't like. And to make it a little bit more fun, you can still deduct up to $1,000 if you're single or $2,000 if you're married filing joint for cash and charitable donations. So think about what you might be giving for church or charity, or maybe even small things that you feel you've done throughout the year. They can really add up. I know when we look for a lot of different organizations that we're a part of, it is really nice. Every little bit helps. And then that really can go a long way even in your deductions. So this historically means if you weren't itemizing, it wasn't a big deal. Now it's good that you can do charitable giving. It doesn't help you really tax-wise, but now at least there's something that will take place of even these small wins. So your heart feels good, the community giving back, but these are other small ways that you're actually going to see this as well. And it kind of allows you to participate in what's important. And we're always encouraging you, participate in the community, be active, do things together. And I think really one of the biggest takeaways for me today for our listeners is tax planning. It's not a December sport, right, Nolan?
No, it's not a December sport. It can be an all-year sport, which is great. And so if you don't have a wrangle on what that means and how you can tackle taxes throughout the year, because there's different strategies throughout the year that you can use, it's just not a fourth quarter thing, then there should be some times that you need to talk to somebody in order to get those clarity points across for the year.
So fewer surprises, of not the kind of surprises that you want, are good. And we also say thank you for joining us on this episode of Beyond the Focus. If you found it helpful, please follow, rate, and review our podcast. We love to hear some feedback, and we're happy to get any deliverables in your hands. Visit us for more resources on focuswealthplan.com or reach out for your retirement tax bill as well. So until next time, on behalf of Nolan and I and the team here, stay focused and keep on leading with purpose.